Okay, so chapter 21 discusses the basic mechanics of Roth plans. Now, we've mentioned these in chapter 19 and chapter 20 to some extent, so this is going to just kind of be a brief overview of the differences between a Roth, let's say, retirement account, usually IRA, a Roth IRA, and a traditional IRA. Okay, so what's really different about this? So the quickest answer to get to the difference here is that it's post-tax. So you're putting into your Roth account after you've already paid tax. Okay, so that means that these withdrawals, when you retire, are tax-free. So if you have $1 million in an IRA or a 401k, and then another $1 million in a Roth, IRA when you retire, then the $1 million in that standard IRA or 401k are going to be taxed at your appropriate tax rate. However, if you have the $1 million in the Roth style account, all that's yours. Every dollar you pull out is a dollar you keep. So you've already paid Uncle Sam his dues. So that's one nice thing. And again, diversification is always, a good tool to use in finance. So I'm not saying that you should put everything into a Roth account. Okay, because your assumption here with a Roth account is, hey, let me pay taxes now because I think they're going to be higher in the future. So let's pay taxes now while they're lower. And right now, that seems to be the case. I would be pretty surprised if tax rates, after 2025, I'd be surprised if they're lower. They're quite low now. Okay, for most brackets. Okay, all right. So Roth IRAs again, and IRAs too. We don't traditionally consider these employee benefits, but you can have Roth 401ks, 403bs, and 457bs. And again, this is a class that's beyond just employee benefits. It's also about retirement planning. And Roth IRA is an excellent vehicle to use in any kind of fair and balanced retirement plan. So when should we use this? Well, again, it's a good way to kind of balance out all your retirement vehicles and diversify a little bit. But if your client here wants to pay taxes up front for the same reason I mentioned earlier, hey, my taxes are low now, let's go ahead and pay them now so I don't have to worry about in the future when I'm retiring, then it's a good option. Okay. Long-term accumulation. So if they're in their 20s, 30s, maybe even 40s, this is fine. If they're 55 or 60, it might be a little too late on that. And then, again, always add this is a good little supplement to other retirement plans. So just because you have a good 401k doesn't mean that you shouldn't also look at an IRA or Roth IRA. So what are the advantages? So number one, since you're already paying taxes on this, so it's coming out of your paycheck after you've already paid taxes and everything, the contribution and investment returns when you withdraw are tax free. Okay, so that's great. You won't be taxed on them. There are no restrictions regarding an employer's plan. So you don't need an employer's plan. It doesn't matter how good or bad your employer's plan is for a 401k or retirement account. You can still do a Roth IRA with two exceptions. Okay, and contributions can be made after the age of 70.5. Now, starting one after that is difficult, but you can continue to make contributions. Now, disadvantages. There are income limitations. So individuals with adjusted gross income greater than 139,000 cannot contribute to a Roth. This is at about the 85th, 90th percentile. So if you make $139,000 a year, you're doing better than most. And for households, this is at 203,000. Okay, and again, this is also roughly the 90th percentile, and again, that depends on where you live, but just across the U.S., that's about at the 90th percentile, and it tends to adjust up to that level as well. Now, that being said, you can do what's called a backdoor Roth and completely circumvent all this. So yes, someone making 139 or more can't do a traditional Roth. They can open a standard IRA, put $6,000 into it, and then roll it over into a backdoor Roth. And it's all the same. Now, of course, they're not going to get to deduct that 6,000 from their taxes because it's going to be post-tax like any other Roth plan. You can also do a mega backdoor Roth. So it is kind of peculiar that there's this workaround. So why even have the limit if there's a workaround? And it wouldn't surprise me if in 5 or 10 years we didn't see a change to this. Again, because there's just a workaround to it. So why have the rule at all? You do still have the $6,000 contribution limit, which that in and of itself would be a notable limitation for someone making $140,000, $150,000 because you're not going to be able to save enough, right? $6,000 a year when you're currently making six figures, that's not enough for retirement. Most would argue. I would put myself in that camp. I would say that's not quite enough in and of itself. But most people are balancing this or coupling it and mating it with a good employer sponsored plan too. Okay. Speaking of employer sponsors, you're not going to see any matching with a Roth IRA. If we have an employer sponsored IRA, a Roth is not common to begin with. An employer sponsored IRA is not common to begin with. So it's pretty surprising and very, very rare to see the combination of those two and then to also see contributions to it. Okay, so there aren't going to be matching contributions in these 99+% of the time. Why? Well, because they're not offered by employers more often than not. Now, for tax implications here, the gist of it is there's no required minimum. So this is exactly what we saw from the IRA slide. So there's not too much different here. That contribution limit is 6,000 or your total yearly earnings, whichever is lower. So if for some reason your adjusted gross income is only $5,000, you can only put $5,000 into your Roth account. Unearned income can't be used. And I do mention here, just to keep in mind, the phase out. So it's not like as soon as you make $139,001, you can't contribute to a Roth. It actually starts at 125 for an individual and 193 for a household. All right, now just some basic plan mechanics, and there's not too much that differs from a Roth and a traditional IRA here, but I do just want to hit the high points. So for distributions and rollovers, a Roth always belongs to the participant, can be withdrawn from any time. You have the same exact penalties. The early withdrawals are not or they are penalized, but it's only on the interest accrued. So this early withdrawal penalty and tax is only on the interest accrued, right? Because you've already paid taxes on this. Okay, so Uncle Sam's, we would say fair. So you've already paid tax on this, so only those interest gains are penalized and withdrawn, right? Because you put $5,000 into it and it's $6,000 the next year, right? And you withdraw all 6,000. You've already paid taxes on $5,000 of that, so you're not going to pay another set of tax or another amount of taxes on that $5,000 and then get taxed on 1,000. No, it's just the penalty and the tax on that 1,000. So whatever is above the contribution. Okay. Funds have to be distributed within 5 years of death. Unless there's a beneficiary, and then they can wait, or beneficiaries can oftentimes roll it over to another Roth account. You can't roll over Roth to a traditional IRA. Why? Because you already paid taxes on it. You ideally won't want to do that, right? You pay taxes on it. Why roll it into an account that once you withdraw, you'll have to pay taxes again? It doesn't make a lot of sense. So compared to your standard 400 series retirement accounts, excluding Roth, 401ks, 403bs, and 457bs. There are no tax deferrals. It's after tax, post tax. It does have that lower contribution limit, just like an IRA. And let me be clear here. This contribution limit, it's for an IRA or a Roth IRA. So you can't put $6,000 in an IRA and $6,000 in a Roth IRA. It's only one or the other. Okay, so that's very important. Okay, so the $6,000 is between either type of IRA. Okay, so it's $6,000 between a standard or a Roth. You can't do 12 total. Okay, so it's capped at 6. There's no matching. Even if there is an employer sponsored plan, it's rare that you see matching anything outside of a 401k. But you do get the more choices similar to an IRA, and then tax-free withdrawals dissimilar to an IRA. Speaking of those employer-sponsored plans, again, very rare. So the only way they can get to a Roth type account would be to offer a Roth 401k, 403b, or 457b. Okay, so I'll give you some options here. Ball State, we can do a Roth style or a post tax option for the 403b and a 457b account, which is really nice. And these are subject to 401k contribution limits. So that means that someone at Ball State, if they wanted to, they could put almost $40,000 a year post-tax into their Roth 403b and 457b. They could probably retire quite early if they wanted to doing that. I'm sure not many people can forget about $40,000 post-tax, but if they have that option, then hey, it's a pretty good retirement vehicle. But another thing to keep in mind, it's not very common. Most 401ks offered some 80 to 85% are not Roth. Okay, so they're non-Roth 401ks or 457bs or 403bs. Okay, so it's 400 series retirement accounts. It's not very common to see these offered as Roths, but it's not, it's not impossible. Like, it does happen, and we have these examples here. The best thing, though, again, about these is that you have a higher limit, right? So you can put even more, or you can diversify a little bit. If you want to save $20,000 a year, you can put 10 grand in a Roth, style account, and then 10 grand as post-tax. Okay, so it gives you that option to diversify. And if you do find yourself with that option, then it's probably a good thing to take. Okay, all right, so that's Roth plans. Again, the biggest difference here is that they're post-tax. So that means once you do get the withdrawal upon retirement, all the money in that account is yours. Okay, so keep in mind these differences when we compare them to either traditional IRAs or traditional 400 series retirement accounts.